Welcome to the Deep Dive, your express lane to understanding the critical insights from the latest earnings calls.
Hi there.
Today, we're plunging into the Q2 2025 earnings conference call for Terex Corporation, ticker TEX. And let me tell you, it's quite a story of strategic transformation.
Indeed. Yeah, this past quarter wasn't just about the numbers. It was really about Terex actively reshaping its entire business.
Right.
We're going to unpack the key financial results, dig into management's strategic moves, and, well, explore what this dynamic environment really means for Terex's future.
We will.
You'll see a company navigating challenges like tariffs by doubling down on what it does best and strategically diversifying its portfolio.
Exactly. We're looking at a company that's not just riding the waves, but is actively steering its own ship, making some pretty big decisions about what businesses to keep, what to sell, and where to invest. So if you're curious about how a major industrial player is adapting to a rapidly changing global landscape, well, this deep dive is definitely for you. Let's jump right into the headline numbers for Q2 2025 then. What did the quarter look like on paper?
Well, Terex certainly delivered. They reported an adjusted EPS, that's their earnings per share, of $1.49.
Okay.
That actually beat the consensus estimate of about $1.40 by a solid 6%. So pretty good there.
Nice beat. And revenue?
Revenue also came in strong at $1.487 billion. That surpassed analyst consensus by roughly 3%, and it marked a healthy 7.6% year-over-year increase.
And it wasn't just top-line growth, was it? They also posted a robust adjusted operating margin of 11.0%.
Right.
And generated $78 million in free cash flow. That demonstrates an impressive 108% conversion rate.
That conversion is key.
It really is. But here's a number that caught my eye. Bookings were up 19% year over year on a pro forma basis, meaning, adjusted for M&A activity reaching $1.1 billion.
Quite a jump.
However, the book-to-bill ratio stood at 73%. Now, for our listeners, what does that 73% book-to-bill really signal?
Yeah, that 73% is a critical signal. It indicates that Terex is shipping more product than they're booking in new orders right now.
Okay.
So this suggests current demand might be, let's say, slightly softer than production levels. And they're likely drawing down some of that existing backlog they built up.
So working through previous orders?
Exactly. It's a move back towards what we might call, normal seasonality after maybe a period of super high demand. But it also reflects a more cautious market sentiment, particularly from certain customer segments.
Right. Makes sense. So the market took all this in. What was the immediate reaction to these results? Any fireworks?
Well, the market reaction was, I'd say, cautiously positive. The stock closed up 2.1% on earnings day, which is, a decent bump.
Not bad.
Not bad at all. However, we did see some intraday weakness in the session after that, hinting that maybe investors are still digesting the full picture. It wasn't a runaway rally, but management's steady guidance was definitely a reassuring factor that likely prevented a larger pullback.
Okay, steady guidance noted. Now, beyond those numbers, what was the real story management wanted investors to hear this quarter? What's the thread connecting all these different moving parts?
Yeah, you hit on it. The CEO really emphasized the power of their evolving portfolio. And what's fascinating here is how the strong performance of their environmental solutions segment, they call it ES.
Right, ES.
It didn't just perform well in isolation, but actually acted as a strategic shock absorber. It effectively offset industry-wide headwinds in their aerial segment.
Ah, okay, so one part compensating for another.
Precisely. And material processing, or MP, also played its part, delivering sequential margin improvement that contributed to the overall stability. So this isn't just about one segment shining. It's really about the entire portfolio strategy showing its resilience.
So this isn't just reacting to market conditions. It sounds like Terex is actively shaping its own destiny. They're making intentional moves to reshape the very core of their business, aren't they?
Absolutely. And if we connect this to the bigger picture, you can really see it in the recent M&A activity. For example, that 2024 acquisition of ESG.
Right, ESG.
It's performing above their initial model, contributing significantly to that ES margin strength, and, importantly, finding impressive synergies across the entire portfolio.
Synergies are always good to hear.
Definitely. And looking ahead, they just announced a definitive deal in early September to sell their tower and rough terrain cranes business to Raimondi.
Another big move.
A very clear strategic move. It streamlines their operations, reduces exposure to highly cyclical markets, and sharpens their focus on higher return verticals. The multi-year arc is pretty clearly defined now. diversify beyond those cyclical aerials, compound growth through ES and services, and relentlessly prioritize cash conversion and disciplined capital returns.
That's a very clear strategic pivot laid out. So let's unpack this portfolio a bit, starting with that star performer you mentioned, environmental solutions. What made ES such a standout this quarter?
Yeah, ES was indeed the segment to watch. It generated an impressive $430 million in sales, showing 12.9% year-over-year pro forma growth.
Wow.
And the margin story here is even more compelling. An impressive 19.1% operating margin.
19%.
19.1, that's a 230 basis point improvement, so 2.3 percentage points higher than last year.
What's driving that?
Well, it seems to be driven by improved throughput, more efficient delivery of critical things like refuse collection vehicles and utility trucks, a favorable customer and product mix, and just enhanced operational execution across the board in that segment.
But that's remarkable margin growth. But they're not just optimizing existing operations, are they? Here's where it gets really interesting for, a traditionally industrial business. What about digital innovation within ES? Are they truly differentiating themselves there?
They absolutely are trying to. Terexs is leveraging the Third Eye digital platform, which actually came with that ESG acquisition.
Oh, the acquisition paying off again?
Exactly. They're extending its capabilities to their advanced mixers and utility trucks. Now, this platform isn't just a gimmick. It provides enhanced situational awareness, improved safety, and real-time fleet visibility for their customers.
Real value adds.
Right. And critically, it's creating a growing software as a service, or SaaS-based revenue stream.
SaaS in an industrial company, that's interesting.
Very attractive.
Yeah.
It's recurring, high-margin revenue. Looking ahead, management expects even stronger ES performance in the second half of the year. Full-year sales are now projected to be up low double digits, which is actually an increase from their previous outlook.
Good sign.
Yeah. Margins are expected to moderate slightly in the second half, maybe about 1% lower than Q2, mostly due to customer and product mix shifts, but still very strong.
Okay. So while ES is soaring, the flip side of this evolving portfolio seems to be the aerials segment. You mentioned it faced some headwinds this quarter. What exactly were the challenges there, and how does it tie back into this diversification strategy you outlined?
You're right, to connect those dots. Aerial sales were $607 million, which was consistent with total expectations, so the top line was okay.
Okay.
However, the customer mix was notably different than anticipated. It was more heavily weighted towards national customers rather than the typically higher margin independent rental customers who seem more cautious right now.
The mix matters.
It really does. While the operating margin did improve 500 basis points sequentially from Q1, which is good.
That's a big jump from Q1.
It is, but it was still about 200 basis points lower than they expected, largely because of this less favorable customer mix. And this weakness, well, it underscores precisely why Terex's multi-year plan to diversify and reduce cyclicality is so critical.
Right, validates the strategy. And what's the outlook for aerials for the rest of the year? Should we expect these dynamics to persist?
Unfortunately, yes, it seems that way. Full year sales for aerials are now expected to be down low double digits.
Right.
Yeah. And those unfavorable customer mix dynamics observed in Q2, they're anticipated to persist in the second half. You combine that with increasing tariff impacts, and it will continue to put pressure on aerials margins.
Okay.
The segment ended Q2 with a little over 4 months of backlog coverage, which, as we mentioned, signals a return to more normal seasonality in that particular business.
Got it. Finally, let's turn to material processing, or MP. Stability sounds good for a segment, but with sales down year over year, what does stability truly mean here? And, how sustainable is it if these macro headwinds persist?
That's a fair question. While MP sales were $434 million, down 9% year over year, the internal execution was actually quite strong.
Okay, focusing on what they can control.
Exactly. The segment delivered impressive sequential growth and margin improvement, showing operational stability despite those external pressures. The operating margin hit 12.7% in Q2, which was right in line with expectations.
How'd they manage that?
Mostly thanks to effective cost controls and some pricing actions that largely offset the tariff impacts we'll probably talk more about. This marked a significant 270 basis point sequential margin improvement from Q1's floor, demonstrating their ability to manage things internally.
Okay, so they're navigating some serious external forces. What are those specific macro factors? Especially, you mentioned Europe earlier.
You got it. Macro uncertainty and persistently high interest rates continue to be a headwind, particularly for things like rent-to-own conversions.
Slowing down decisions.
Right. The European market for its part, remained weak, though management did highlight some maybe early signs of potential recovery emerging. Just green shoots, perhaps.
We'll take green shoots.
We will.
Yeah.
For the second half, MP expects margins to improve further, with Q4 margins specifically projected to be higher than Q3. This is attributed to better factory absorption and maybe a more favorable geographical mix later in the year. Full-year MP sales are still expected to be down high single digits overall. In North America, they're seeing caution in smaller private projects, but interestingly, strong tailwinds from large-scale mega projects.
Kind of a mixed bag there, too.
Very much so.
Now, tariffs. This has been a huge recurring theme for so many industrial companies. How is Terex positioning itself to handle this escalating global trade tension, and what's the impact been?
Yeah, this is where their Made in America strategy really comes into play as a key mitigation factor. It's quite interesting. Approximately 75% of their projected 2025 U.S. machine sales are expected to come from products manufactured right here in their 11 U.S. facilities.
75%. That's significant.
It is. This includes their full line of those environmental solutions products we talked about and a significant portion of their genie booms and scissors. It's a deliberate strategy to build supply chain resilience and, well, hedge against some of this tariff volatility.
So domestic manufacturing is a hedge. What's the bottom line financial impact of these tariffs on their overall outlook? Has it changed?
It has, and it's certainly a growing concern. The estimated overall net impact of tariffs for the full year 2025 has increased from an initial projection of about 40 cents per share to roughly 50 cents per share now.
10 cents higher. Why did the increase?
It's primarily driven by three factors, unfortunately. First, the EU reciprocal tariff increased from 10% to 15%. Second, higher secondary tariff impacts sort of knock-on effects than they initially expected.
Okay.
And third, the doubling of U.S. Section 232 steel tariffs from 25% to 50%. So yeah, it's a multi-front challenge.
Oof, that's a lot to offset.
It is. Terex is actively working with suppliers, exploring alternative solutions like re-engineering products or insourcing components, and, of course, using pricing adjustments where they can to offset these pressures. But it's clearly an uphill battle.
Definitely something to watch. Beyond the operational and strategic shifts, let's talk capital allocation. How are they managing their balance sheet and maintaining financial flexibility in this somewhat uncertain environment?
Well, Terex maintains a very strong financial position, which, gives them a lot of optionality. They boast $1.2 billion in liquidity.
Solid.
And no significant debt maturities until 2029. So they have runway. They also remain committed to returning capital to shareholders. They repurchased $21 million of stock in Q2 alone, bringing the total to $53 million for the first half of 2025, and they've authorized a new $150 million share buyback program.
Signaling confidence.
Seems like it. And they also declared their quarterly dividend of 17 cents per share.
Okay. And on the debt side, are they taking any steps to strengthen their position even further?
Yes, they are. In August, they proactively repriced their term loan. That's expected to lower their cash interest payments, which further supports that strong free cash flow generation we talked about.
Smart move.
And crucially, they plan to delever, meaning reduce their overall debt load in the second half of the year, primarily through increased cash flow from operations. This move strengthens their balance sheet and provides even greater financial flexibility for, future strategic initiatives or weathering storms.
Right, building that resilience. So despite all these dynamic forces, the strategic shifts, the tariff pressures, macro uncertainties, Terex maintained its full year 2025 outlook. Remind us, what are those key projections?
You're right. Maintaining guidance amidst such a complex backdrop, well, it does speak volumes about management's confidence, or at least their visibility.
Yeah.
They project full-year sales between $5.3 billion and $5.5 billion.
Okay.
Adjusted EPS is expected to be in the range of $4.70 to $5.10. And it's important to remember that range now explicitly includes that 50 cents of net tariff impact we just discussed.
Factoring it in.
Got it. Exactly. EBITDA is anticipated to be around $640 million, with free cash flow between $300 million and $350 million. That implies that strong conversion rate again, over 120%.
That free cash flow conversion is really something. And how does that break down quarterly for the second half? Are we looking at a steady climb or something more nuanced?
It's definitely nuanced with a bit of a twist, actually. Interestingly, they expect Q4 EPS to be higher than Q3 EPS.
Higher in Q4. Usually things slow down a bit then.
Right. You might expect that.
Yeah.
But this is attributed to the timing of their tariff mitigation actions really kicking in later in the year, along with those anticipated higher Q4 margins in the material processing segment we mentioned.
Oh, okay.
These factors are expected to more than offset the sequentially lower sales volume they anticipate in aerials during Q4. So yeah, they're planning for a stronger finish to the year, earnings-wise.
Okay, interesting dynamic. Thinking bigger picture now, what are the broader economic currents shaping Terex's business right now? We're seeing a lot of mixed signals out there globally.
That's a perfect way to put it, mixed signals. They're seeing both significant tailwinds and some persistent headwinds. On the positive side, what they call the Big Beautiful Bill, which likely refers to the bipartisan infrastructure law.
Right, the infrastructure bill.
That's seen as a major boost.
Mm-hmm.
It includes the reinstatement of 100% bonus depreciation for qualified production property and also new bonus depreciation for qualified non-residential real estate.
And that helps equipment demand.
Hugely supportive, yes. It encourages equipment demand and increased U.S. industrial activity, manufacturing, CapEx, things like that.
And within specific end markets, where is Terex finding that resilient strength you mentioned earlier?
Yeah, they're strategically positioned in several incredibly resilient markets, which is part of that portfolio strategy. Waste and recycling, that accounts for about 30% of their global revenue.
Pretty stable.
Very stable. Utilities are growing 10%, driven by grid expansion needs, and infrastructure makes up another 15%. Combined, those three markets represent over half of their revenue and are proving highly resilient through cycles. They're also seeing growth in emerging markets like India and Southeast Asia.
But not everything's rosy.
No. U.S. construction, for example, has what they call a two-speed profile. Strong demand in large public projects and infrastructure, definitely benefiting from that bill.
Right.
But some softness in smaller local private projects, probably impacted more by interest rates.
Makes sense. And on the flip side, what are the challenges they're actively managing? What keeps management, up at night?
Well, persistently high interest rates are definitely one. And that ongoing tariff-related uncertainty continues to impact capital expenditure decisions for their customers.
Especially those independent rental guys.
Yes, exactly. Independent rental customers, particularly, remain cautious, which directly impacts the aerials segment, as we saw. Europe is also experiencing a generally weak economic and construction environment, at least in the near term, though maybe there's a more encouraging long-term outlook for the region. Looking ahead, for you as a listener trying to gauge this, several factors could significantly impact Terex. Potential catalysts could include continued environmental solutions capacity expansions, building on that strength.
ES growth.
Right. Also, the successful closing of that Raimondi divestiture, getting the cranes business off the books smoothly, and maybe a normalization in rental fleet capital expenditures from those independent customers if they start feeling more confident.
If rates come down, maybe?
Perhaps. Further easing of tariff headwinds, though that seems uncertain, increased adoption of their digital solutions like Third Eye, and additional synergies from the ESG acquisition could also provide upside. And looking out to 2026, there's potential upside from that bonus depreciation really driving incremental investments, and ES margins could continue to benefit from synergies.
Oh.
And the effective tax rate is expected to normalize around 19% then too.
Okay, lots of moving parts. And what are the main risks to keep an eye on? What could derail their trajectory?
Well, number one is probably persistent tariff uncertainty, particularly if those EU reciprocal tariffs or steel tariffs get worse or if new ones pop up. That remains a key risk.
A big unknown.
Huge unknown. Continued caution from independent rental customers is another risk factor. Prolonged high interest rates, obviously. And a weaker than anticipated European market recovery could also weigh on performance.
And internal risks.
Yeah, always execution risk. Challenges in integrating acquisitions smoothly or fully realizing those planned synergies, or unfavorable customer mix shifts continuing to hurt margins. It really comes down to how well they can continue to execute their strategic pivot against all these external pressures.
A lot to navigate. All right, it's time for our This Is Not Financial Advice segment. Remember, everyone, this is purely for entertainment and conceptual exploration, not a recommendation to buy or sell anything.
Absolutely not advice. But given everything we've discussed about Terex's Q2 performance and their strategic direction, here's a thought experiment for your hypothetical investment committee.
Lay it on us.
Okay. Consider perhaps a long position in Terex, ticker TEX, while simultaneously exploring a short or maybe an underweight position in a peer company, specifically one that has less diversified revenue streams and maybe higher exposure to those pure play rental markets or less robust domestic manufacturing.
Interesting. A pairs trade concept. What's the full rationale behind this somewhat audacious idea?
Well, the core thesis here is Terex's accelerating strategic pivot. They're moving aggressively towards more resilient, potentially higher margin segments like environmental solutions, utilities, and infrastructure.
Playing defense and offense.
Kind of, yeah. Their Made in America footprint acts as a natural structural hedge against escalating global trade tensions and tariffs, an advantage many competitors might simply lack right now.
That domestic production angle.
Exactly. And that third eye digital platform, it's not just a flashy feature. It's an early stage, recurring SaaS revenue stream. That adds a future-proof, high-margin element to an otherwise traditional industrial business model.
The tech component.
Right. While the aerial segment clearly faces headwinds, the overall portfolio is actively being de-risked through those strategic acquisitions like ESG and divestitures like the crane business.
Shaping the portfolio.
Actively. The maintained full-year guidance, despite the tariff hit, plus the robust free cash flow generation and that ongoing share buyback program. It signals pretty strong management confidence in their ability to execute amidst all this uncertainty.
Okay.
So the idea is, if that big, beautiful bill stimulus, particularly the bonus depreciation part, really begins to translate into tangible capital investments in 2026.
If the spending comes through.
Then Terexs seems strategically positioned to capture that upside, potentially outperforming peers who are maybe more exposed to the volatile traditional construction cycles or international trade dynamics. It's basically a play on strategic resilience and a kind of tariff advantage transformation story.
A play on resilience and transformation. Got it. Well, that certainly gives us something to think about.
Just thinking out loud.
So there you have it, a comprehensive deep dive into Terex Corporation's Q2 2025 earnings call. We've seen a company leaning aggressively into its strengths, particularly environmental solutions.
Definitely the star right now.
While actively reshaping its portfolio and navigating some significant macroeconomic shifts and tariff pressures with a pretty clear strategy.
Yeah, their maintained full-year outlook, coupled with that strategic capital allocation and robust free cash flow generation, it paints a picture of a company with a, let's call it, cautiously constructive outlook.
Cautiously constructive. I like that.
And the ability to manage those tariff impacts, at least partially, through a strong domestic manufacturing footprint and leveraged digital innovation, are proving to be key differentiating factors in what's clearly a challenging environment.
Absolutely. This deep dive has explored the critical factors influencing Terex's present and potentially its future performance. As always, remember that the insights discussed here are for informational purposes only. They do not constitute financial advice.
Please don't trade based on this.
We encourage you to continue your own research and due diligence, because truly being well-informed is, well, it's a continuous journey.
Thanks for joining us for this in-depth analysis. We appreciate you tuning in.
Until next time, stay informed and keep digging for those insights.